There's a big pile of losses hiding on the balance sheets of America's pension funds, and you may not even know it yet. I'm not talking about the stock market or the bond market or housing. I'm not even talking about banks or commercial real estate. I'm talking about private equity. Shares in privately held companies make up a major percentage of America's pension funds. Those assets are notoriously difficult to value, and since interest rates are so high, they're probably not worth anywhere near what these funds are claiming. And in order to hide those losses, both private equity firms and the pension funds that are investing in them have started taking out expensive debt to generate the cash flow that they need. And if they're not careful, they're going to make things worse. What's up, guys? I'm Nobody Special, and a few months ago, I made this video about how private equity firms were taking out NAV loans, or net asset value financing, in order to borrow against their privately held companies to generate the cash flow that they needed to pay out distributions or the illusion of profits to their investors. And in that video, I mentioned how this may not meet the textbook definition of a Ponzi scheme, but taking on new debt to pay the proceeds of prior investments does smell a little Ponzi-like, and that this phenomenon was becoming widespread in the private equity space, where investors pool their money to buy privately held companies that haven't been sold to the stock market yet. Well, some of the biggest investors in these private equity firms are sovereign wealth funds and America's pension funds, and now those pension funds have also started taking on debt in order to generate the cash flow that they need, because private equity won't sell their assets and give them their money back. And it's starting to cause problems. And if the Fed doesn't ride to the rescue and lower interest rates far enough, fast enough, could end up causing a big problem in our pension system that, through a series of political overreactions, ends up causing a whole new wave of inflation. Let's head over to the Financial Times with this article dated January 20th. U.S. pension funds worth $1.5 trillion add risk through leverage. Retirement systems allow more borrowing and derivatives as private holdings strain cash flows. U.S. public pension plans that manage hundreds of billions of dollars of assets are increasingly turning to risky leverage strategies as burgeoning private market holdings create cash flow strains. At least 8 very large U.S. public pension funds are using borrowed cash or other leverage strategies now that the board of CalSTRS, one of the largest U.S. retirement funds this month, voted to allow the fund to borrow as much as $30 billion, or 10% of its portfolio. The strategy has risen in prominence as these giant funds have tied up a larger and larger share of their assets in illiquid investments, such as private equity, infrastructure, and real estate. Using borrowed money and derivatives can help boost returns, rebalance portfolios, and give the funds access to cash without having to resort to fire sales of illiquid assets during times of market stress. Now, guys, remember, as I mentioned in that video from a few months ago, those private equity firms are already taking out NAV loans against these privately held companies that they own, because they know if they have to sell these companies, that there's just not many buyers. It's an illiquid market, and when you sell into an illiquid market, you can crash the price very quickly. And so to avoid selling those assets, these firms are borrowing against them to get minimal cash flow that they need just to keep their investors placated. Well, now the investors are on the other side saying, we're waiting for these private equity firms to pay us back, and so we're going to borrow against our fund also in order to generate the cash flow that we need. You've got both the PE firms and the pension funds are both taking out leverage in order to hide the fact that they're holding assets that are not worth what they're claiming they're worth, and if they go to sell those assets, they're going to find out real fast that the price is a whole heck of a lot lower. And so to hide that, they're taking out debt that comes with double-digit interest rates. The article goes on to say, but the use of leverage can backfire, as it did during the 2022 gilt market crisis, when forced selling by UK pension funds led to an emergency intervention by the Bank of England. Global regulators have recently stepped up scrutiny of the practice, as well as broader systemic risks posed by non-bank financial institutions. If you're borrowing money to help avoid fire sales, then this is a risky strategy because the money still needs to be paid back, said Alistair McDonald, head of investment strategy with WTW, a global professional services firm. There is still a risk that assets will have to be sold at low prices to repay the borrowing, locking in losses. So what's going on here is kind of like if you bought a stock and that stock crashed in value, but you still need cash. You go to the bank and you take out a loan and you say, it's okay, I just need a little temporary cash infusion to tide me over until my stock goes back up in value. Well, if the stock doesn't go back up in value and you end up selling it at a loss anyway, You still have to pay back the loan plus all the interest you took out. You just made the problem worse. And the biggest investors in the private equity space are starting to catch on to this, and they've told the PE firms enough is enough. You guys need to unfreeze our money and start paying us back. Otherwise, we're going to start sitting out your next round of funding. Here we go in Fortune, dated January 16th. $8 trillion private equity industry faces real cultural change as sources say investors are pulling funding amid a deal apocalypse. Remember, private equity funds need to sell their companies in order to get any profits to pay back their investors. The typical form that takes is with IPOs, initial public offerings, when they sell those companies to the stock market, or during mergers and acquisitions when these companies get bought out. But since interest rates started going up 2 years ago, the IPOs and the mergers and acquisitions have really slowed down, so these private equity firms don't have a lot of cash on hand. They've stopped paying out distributions to their investors, and their investors are finally saying, no more money for you. Some of the most influential investors are giving the world's largest private equity firms a message. If you want money for your next fund, here's our list of demands. Sovereign wealth funds and state pension providers are among investors telling money managers they'll only commit in their upcoming fundraisers if their capital tied up in old funds is released, according to people with knowledge of the matter. And it looks like we may find out just how bad this problem is very soon here. Again, in the Financial Times, dated January 19th, private equity predicts deal rebound as sellers capitulate on prices. Davos dealmakers say pressure to return cash to investors will push buyout houses to sell investments despite low valuations. So it seems the pressure from the big investors is catching up with these PE firms. They've done everything they can. They've taken out these NAV loans. They've strung them along long enough, and now they're finally going to call it quits, and they're going to have to sell at market prices. And when that happens, who knows what these companies are actually going to be worth, because interest rates are a whole heck of a lot higher now than they were just a few years ago when these firms were bought. Private equity executives are predicting a sharp increase in takeover activity as buyout firms that have held on to investments in the hope of higher prices finally begin to capitulate. There's been a marked drop in private equity groups selling portfolio companies since a peak in 2021, as rising interest rates have made financing more difficult and hurt valuations. So what these two paragraphs are saying is these firms are finally out of time. They're going to have to just bite the bullet and sell these companies, and they're going to have to take less money for it. We'll see just how bad that value drop has actually been due to that rise in interest rates. Investors in buyout funds have begun to increase pressure on groups to sell long-held investments and start returning cash, however, forcing them to reckon with lower prices and lock-in returns. For the last 24 months, there has been a disconnect on valuation expectation between buyers and sellers. There's now a real sense of pragmatism setting in, said Anna Skoglund, who leads the European Financial and Strategic Investors Group at Goldman Sachs. So long story short, nobody really knows just how big the losses on these private equity investments are for America's pension funds, but we may be about to find out. Those PE firms have taken out NAV financing, trying to avoid selling those illiquid investments, knowing it would drive their valuations down. They've been using those funds to pay distributions to their investors. Those investors have started taking out their own debt, trying to avoid forcing those PE firms to sell at lower valuations. So we've got leverage on top of leverage, and now sovereign wealth funds and pension funds have told those private equity firms, you will get no more money from us until you release the money that we've already given you. And that is forcing those PE firms to capitulate and sell those assets at discounted valuations. And when all is said and done, I guess we're going to find out how much money they actually got for those companies and how much is left over after they pay the interest and the principal back on that debt they've already borrowed. And then we find out just how much trouble your pension might be in. Now, to put that in perspective, let's look at California's pensions. CalSTRS, the California State Teachers Retirement System, they keep about 16% of their portfolio in private equity. Another big California pension, CalPERS, or the California Public Employees Retirement System, they keep about 15% of their assets in private equity funds. Now, while that may not seem like a huge allocation, also keep in mind that those two pension funds are both notoriously underfunded, with a funding ratio of only about 72 to 75% between the two of them. So those funds already have big shortfalls, and we don't know how much money those private equity investments may have lost or how much money they owe on the debt against them, so those shortfalls could be getting even bigger. Now, I want to emphasize that we don't know just how big this problem is. I'm not trying to say, oh, all the pensions are going belly up tomorrow. That's not the case here. But we do have a pension system that already has pre-existing problems, and this will make that worse. If it makes it much worse, we could be in a situation where pension systems are demanding bailouts, and they'll get them because grandma's losing pension funds is very bad politics. So all the politicians will be united in demanding that the government bail out the pension funds. That's when President Biden goes over to Janet Yellen and says, hey, Janet, need a few $billions to bail out some pension funds. Go ahead and issue those new government treasury bonds so we can borrow the money to give to the pension systems. And that's what Janet Yellen will do. Those new bonds, though, will increase the supply of bonds into a market that already has very limited demand. That will drive the price of those bonds down. And remember, bond prices and interest rates are inversely correlated, so that will drive the interest rates higher on those bonds. Well, that's going to make the PE problem even worse because higher interest rates is why those asset valuations are down to begin with. And it's at that point that Jay Powell over at the Fed steps in with his money printer to monetize that debt, printing money to buy those U.S. treasuries in order to bid up the prices on those treasuries and push those interest rates right back down. And while that may solve the nominal problem at the pensions to make them whole, it will also devalue the future dollars that those pensions pay out. And so, yeah, you'll get your money back, but your money will be worth a whole lot less by then. And it would also reignite inflation, which is what got us into this whole mess to begin with. Till next time, live small and dream big.